Money Vikings. All right, Money Viking G here. Welcome back to the channel. Thank you as always for joining me. Thank you for tuning in to our little, corner of the internet in terms of wealth building. The whole goal of our channel, if you're new here, is to be a wealth building community for middle class, normal folks, not for the one percenters, not for the tech moguls, not for the sports stars and the movie stars that make all the money, but for normal middle class people with average, maybe a little above average salaries, just trying to build wealth in the modern world. So that's the whole ethos of what we're doing, and we sprinkle in, of course, stuff, fun things like collectibles and that kind of stuff that I really enjoy. So today I got a really good one for you. I wanted to do 5 sort of hard truths of investing that I think can really help a person in their investing and true wealth journey. So I want to do 5 sort of just hard truths. These are truths that I learned over time. I learned many of them the hard way, unfortunately. On the other end, fortunately, I had enough sense to not totally fall into these traps, but I did have to learn these the hard way, and I wish someone had, wish I had a crystal ball, and I wish someone had taught me a lot of this earlier. So that's the point. So I want to go into them right now. So the first one is, over the years, I am shying further and further away from individual stocks. Do I think there's a place and a time for individual stock investing? Yes, I do. I understand if someone has a strong conviction, really believes in a company, just really gets into it. They love the products, they love the management, they love the ethos, they love the prospects for profit, etc. So I understand having some of that in a portfolio, and I have done that over the years, and I still have a little bit of that. But at the same time, I've never found that to be a very good foundation for strong wealth building over time. Individual stocks do carry a lot of individual risk. You're very much just dependent on that one company, that one industry, that one niche, whatever it might be. The only big exception, which I don't even really consider an individual stock, which is kind of ironic, is Berkshire, right? So Berkshire Hathaway, that is an individual stock. But as you probably know, it's comprised of like 100 different companies. So I kind of think of it more as a wrapper for a sort of small ETF or mutual fund. But anyway, that is an individual stock that I do hold, will continue to hold no matter what happens. There's reasons for that. Some of that, and some of that probably isn't very rational from an investing standpoint. There's probably some nostalgia there, but there is some belief in the philosophy, and there's a track record there, of course, that is very, very, very good. But anyway, bottom line is, and again, none of this is advice. We don't give advice. There's no telling anyone what to do here. I just share what I do. And if that helps somebody, great, and take it for what it is. But for me, over the years, I'm doing less and less of the individual stock investments. So that is that. I don't chase IPOs. So I've tried that a couple times, and I know what you're going to say, or I know what some people might say. What about Facebook? What about this? What about that? Yeah. Are there the exceptions out there? Sure, there's exceptions, but a lot of times IPOs just get a lot of hype, I've found, and they typically sort of hype up, and then they kind of come back down to earth, and then basically the company is left with only its fundamentals to fall back on, and it has to be judged on those fundamentals. Again, I might put this in the individual stock concept. If it's something that, again, maybe you're personally involved in, or you just really believe in, maybe a small position, that'd be good. And everything I'm talking about is about diversification. What I'm trying to say about less individual stocks is, I'm not saying don't have any individual stocks, but I just wouldn't make it 75% of my portfolio. If I believe in one company, I may love Apple products. I may love, clicking on Amazon every day and having 16,000, shipments at the door, but like most of us. But at the same time, it's very risky to an overall wealth building strategy and portfolio to have all your eggs in that one basket. So that's basically what I'm saying on those two. Okay, third hard truth of investing that I've found over the years. It really is, it's become cliche, but patience in investing is like, it's just, I don't know what the word is, but that is the critical habit or the critical sort of characteristic of yourself that probably has to be developed. I've just found that it pays to wait. Now, there's exceptions to this as well. I mean, there are some, they say dogs that won't hunt. There are some stocks and some ETFs that you just sort of, you ride them for a while, but at some point you're just like, this does not work. This is not working as an investment vehicle. This is not working as a wealth building vehicle. I frankly put some of the ARK ETFs in that bucket for me personally. Those are some that I liked the innovation vision, but over the years, they were not returning. They were not adding value, while the S&P 500 was totally adding value in other investment vehicles. So, but a lot of times it pays to wait. So if, when you first buy a stock or you first buy an ETF or a mutual fund or whatever, the ironic thing is typically it just goes down, right the day after you buy it. But, you have to have some kind of patience. Investing is definitely a long game, and it just, in my mind, has to be thought of in various buckets. So that's kind of the way I've thought of it over the years. I design these portfolios, and you design your investments and the way you manage your capital is you can design it in buckets, right? And I would rank it from things like, you have basically your first lines of defense are like your checking, your normal credit union or bank checking and savings account, right? So those are the things that you've got to actively use that every month to pay the bills, to pay for your life, to pay for trips, to pay for your car, to pay for your gas, to pay for school, whatever it might be. But from there, you should have tiers of buckets that basically don't really get moved or touched that often, right? So you have like the long-term investing stuff, which really probably shouldn't be touched that often. You might have long-term investing in real estate of some kind. Well, you're not really doing much with that except maintaining it over the years. You're not trading houses or trading apartment buildings or trading commercial properties all the time. I mean, there's so many costs to that, it wouldn't make a lot of sense. So that's like the very long-term stuff where you're thinking, decades out. You probably have a middle tier of things, maybe investment vehicles where you're thinking, I'm going to have this for 5 years, right? Maybe you have something that you're going to hold on for 1 to 3 years, and then you have like your checking and savings, which changes all the time. So anyway, bottom line though is it typically pays to just be patient and wait. Again, with the S&P 500, which is probably the biggest investment driver for most people, you look at that long arc. Yes, there's years where it dips, but if you look at the long arc over the decades, it just goes up and up and up and up as the economy grows, as companies innovate, and again, remember, it's self-cleansing. So like the weaker companies fall out and better companies come back in. So you just have to keep that in mind. So I've always found it pays to wait. Okay, fourth thing I want to mention. I no more penny stocks. I don't do any penny stocks. So I did a little bit of experimenting with that for a year or two, and that was another one that I found very frustrating. Again, there'd be hype around a certain company. It might blip up for a little bit, but you have to ask yourself, why is this a penny stock? And there's typically reasons why it's a penny stock. It's a penny stock because the company really doesn't have much going on. And, the management is incentivized to create smoke and mirrors. And, I'm not saying it's illegal. Maybe they really have hope in their product that it's going to take off, but these companies just don't really typically work out. So no penny stocks, no Wolf of Wall Street for me. And the fifth hard truth is this. The fact of the matter is a lot of what we've talked about on Money Vikings has actually worked over the years. And what I mean by that is the biggest thing is a strategically diversified portfolio. And that really has to be tailored to you as an individual. You have to understand your risk tolerance, You have to understand what kind of volatility you can deal with. You have to think about your age and where you are in life. You have to think about your income. You have to bring all that together to build a portfolio that works for you. And, for some people out there, it's going to be very plain vanilla. And you know what? They're going to be fine. Maybe for somebody it's 50% in S&P 500 index mutual fund and it's 50% in a bond fund. And you know what? They just contribute to that every 2 weeks for the rest of their career for 30, 40 years. And you know what? They're probably going to be fine. They're going to end up with a nice pile of assets that they can use as a passive income machine. So that is one example, but there are obviously, 100 different variations of that. And, maybe someone wants to add some hard assets like private real estate investments. Maybe somebody wants to add some crypto and Bitcoin. Maybe somebody wants to be more focused on tech and AI. They see that as where the real big growth drivers are. Probably true. Robotics, whatever. They want to have areas where they're in a niche. Maybe somebody's just totally Berkshire Hathaway type. It's all value investing. And there's like, what? I just like these classic companies that have a real product, make money, hand over fist, year in, year out, selling their product, and it's going to be fine over the long run. You have to decide what levers you're going to pull and where your buckets are going to be, right? And you're going to have more high risk buckets, you're going to have medium risk buckets, and then low risk buckets. But remember, things that sometimes seem like they are low risk, like a savings account, is actually high risk, to be honest, because yes, you're not going to see a lot of volatility, but that savings account that pays 0.1% interest is losing ground every year at the rate of 3 to 5% at a minimum as inflation takes a bite out of the value of our dollars. So the reality is, to even make it in the world, we do have to do some investing. So I hope those 5 truths help you. Thanks again for tuning in, and I'll catch you on the next one. Thanks. Bye.